Hello YouTube, welcome back to another video. Just talking about prepayments in this case. So this is the flip side of deferred revenue, which is a separate video that we've done, just walking through how deferred revenue works. It's much the same, it's just the flip. So in this case, it's an expense, it's an asset, rather than what we have in deferred, which is revenue and a liability. A lot of the mechanics are very similar. So, if you want another view of it, of prepayments, probably also worth jumping over to the deferred video and having a look at how the flip side works. A lot of accruals are all worked in the same way. So if you sort of have an understanding of the two sides of the coin, you can forecast and model or customize and model a lot of this type of stuff in various permutations. So we're jumping off on our base model again. We'll insert the relevant pieces that we need to look at prepayments. And this is an Aussie-centric model as well, Australian-centric model, as it deals with the GST impact. So again, in other jurisdictions, it could be VAT or value-added tax or other tax schemes. But for the purpose of this, we'll look at GST. Some of the logic will likely be similar, if not the same, just different names. So if we dive straight into it, again, we're using Modano as the platform, and then the content that we've pulled together in here. So we've got our base model with a lot of the extra noise taken out, so we can focus on the specific line items. What we'll do is we'll insert our prepayments calculation, and we'll insert our prepayments structure or balance sheet item. Just while this is inserting, in terms of covering it, we're looking at the fundamentals. So the starting point being non-cash shifted or non-delayed payments, as well as so dealing with that first, then coming back to visit the impact of cash and timing delay. So if we jump into our section here, you'll see that the layout of this, if you've seen the deferred revenue video, is quite similar. And like I said, a lot of accruals are done this way. There is the initial recognition and then the balancing release or movement of it. Technically, you can do this on a single line, but yeah, we just want to break the two movements out to deal with the tax implication. Because if you another way to model some of this stuff is just movements on the balance sheet as well, and separately recognizing the revenue or forecasting the revenue. It's absolutely doable. There is the downside of ensuring that the GST, or again taxes, from a cash flow perspective, are managed appropriately. So if we have a look at our monthly financials, again, the annuals are there, but it's easier to see on a monthly basis. So if we set ourselves up, and let's just say we're looking at something like insurance, because insurance is a common one that gets paid in advance, and it is then recognized over a period of time. If you don't do that, then in certain periods in the year, you'll have poorer performance on an ongoing management perspective than future periods, and it's a bit it can create a skewed view of the year. And obviously, the bigger the number, the more the skew is. Prepayments may not be as big of an impact as something like deferred revenue, which is a significant component of the business for a lot of technology companies. That the whole business model is around this. Whereas with prepayments, it's more individual. It could be software. It's probably mostly software if you think about the flip side of it. But yeah, it's mostly software. It could be insurances, maybe rent. Although there is although there is different ways of looking at rent now because of all the new standards. But again, another video for another time. So insurances. let's just work our example. So insurance prepayments, let's just call it insurance prepaid or insurance, allocating it to a relevant category. Now, let's just do a nice round for 12 months figure. So 3,600 for 12 months. Depends on obviously how much your insurance is. If we then carry this across 12 months, we can recognize it over the 12 months. So yeah, invoice, assume we receive the invoice in July. We then use it for the period of July. Again, if you want to get pedantic or specific, there is some component where maybe you start mid-month, maybe you should recognize mid-month. Look, you can do that, but this will broadly get the cash flows correct, which is pretty important, and the relevant timing. I mean, on the assumption that you renew anyway, you're likely going to roll over or just roll over onto a new period, and that will carry the next set of forecast assumptions. That's a refinement thing. If you want to improve your forecasting, absolutely, this is getting the fundamentals right. So, invoiced in July 21, bit outdated, but that's all right. Invoice in July, recognized for 12 months to June. Now, we've got an error. We just need to make sure that we've got that allocated to insurance. Cool. So on the financial statements, again, we're looking at three-way because we want to make sure we've got the profitability perspective, statement of position, financial position or statement of position, balance sheet, whatever you call it. We want to make sure that's correct. And then looking at the cash flow side as well, and the impact of the cash flow. So if we examine the P&L first, we've got our recognition, as you would have seen from this corkscrew down here. So opening balance, the new bill that you've received, billing of your insurance. Then you've got your corkscrew to recognize and bring that down over time. So if we look at the P&L, we're recognizing that 300 over 12 months gets us 3,600. Cool. Now, if we look at the balance sheet, we've created the liability of 3,300. That is like the P&L, but obviously on balance rather than an amount. We're bringing that down to zero as we recognize the asset. So, like as deferred is a liability to a business where you need to do something over time. This is an asset because you are owed something that gets that you can use over time. Cool. So in this basic example, we've also got the GST or sales tax implication. So, like deferred revenue where you collect on behalf of the government. In this example, you're paying for the GST component and you collect that component back from the government on assessment time. So we've got 3,900 in cash as a negative. The GST liability, or in this case an asset, you technically can have it as an asset, a GST asset or a GST receivable. We find it simpler to just condense it into a single line, but we've got a receivable here, so it's a negative liability. And then this balances us out. So if we then look at it from the cash flow statement side, 3,600, 360, so the 3,600 for the underlying invoice, 360 for the GST payment, 3,960. That's why our cash balance is negative 3,960. And then in our example, it's a quarter-end assessment, payment, in this case, receipt of the taxable amount is 360. So we'll receive it back a month after the quarter. This is the basic example with no time shifts. So obviously now we can look at time shifts. So if we have terms from our insurance provider, it's giving us terms for payment, then we can add a delay to that. And just remember that is a balance sheet and a cash flow impact. the P&L should not change because we're still recognizing over the period that we're using the insurance. It's merely a movement of the accruals, of the cash, sorry. So if we jump into our working capital, and if you've seen deferred revenue where we dealt with days terms, we're going to do the same thing here. Again, this would make a lot more sense with more expenditure, but for the purpose of demonstrating the timing, I'm just going to assume 15 days. So on average, half of our expenses are paid in 1 month, in the month of, and then the balance of the invoice is paid in the next month. Again, probably doesn't make sense for a single invoice, but in aggregate, the logic is makes sense, and it probably is the same for most businesses as well. So if we then jump over to our balance sheet and have a look at what that means for us, we'll see the recognition side has not changed. We'll see that the accounts payables have now been created. So what that means is we now have an owings. So essentially, if we have that owing, you know what? Let's take a step back. It might be easier if we just go 31. So let's just shift all of the payments into next month. So again, starting again, if we go cash, in the first period, no payment, so cash is still 0. We've still starting to recognize because we need to, we've got the rights to the insurance coverage, and then we now have an accounts payable amount of 3960, which represents the 3600 underlying invoice, and the 360 in GST that we will be paying, but it is an asset to us. We will receive it back from the government. So 360, you'll see if we expand this, that should reflect similarly. So the 3300 plus the 300 is the invoiced amount plus or less the recognition. You'll see in other periods it's just netting off to 0. But in the movement in creditors, we now have 3960, so the full amount is payable. And then netting those movements off against our GST gives us 0. We haven't paid any cash out the door yet. Now, in the month of payment, so next month, we fully pay it, 3960 leaves the door. So cash payment, we can expand this again, 300 again for the recognition, 300 for the recognition, 300 for the expense recognition, and 300 for the movement in the prepayments. Our movement in creditors, so the payment of the full invoice plus GST, is also noted here. And there's no other GST impact because we haven't dealt with the assessment until receiving it. So you'll see that the cash balance has gone from 0. We go 3960 because we've made the payment. We are now 3600 because we've received our GST claim back. And so, this is how we would do a model for prepayments and how it impacts the financials. Like we said in the deferred, you can drive this, you can get granular if you want, you can build out drivers to lead into this, but the fundamental is there is an invoice, there is a bill that you've received that needs to be addressed. Then there is the recognition of that bill over time. Hopefully, between deferred revenue and prepayments, this has helped you better understand how accruals work on the balance sheet and the impact on P&L and cash flows. We'll address a few other items in coming videos. Any comments, queries, questions, drop it in the comments. Otherwise, thanks for jumping in. Thanks for spending your time to learn a bit about prepayments and modeling with prepayments. Until the next video, thanks for joining in.